play another one bites the dust before you kind of come on? Do you do that at the end? I don't know. Anyway, thank you for that introduction, Paris. As he mentioned, I'm joined by three great speakers this afternoon. It's really good, actually. The lights are so bright that I can't see anything in the audience, so I'm just going to assume that it's absolutely packed to the rafters. I am joined here with Chris Thomas, who I'm very happy I spoke with before I came on stage, because I looked up the name of his VC firm, Assembly Ventures, and it came up by telling me that it was a lifestyle and kind of nutrition VC investor. I'm like, okay, that sounds interesting. And apparently that's just another one by the same name in London. So always good to communicate with your speakers. So Chris is from a Detroit-based VC called Assembly Ventures, and they invest in mobility in all its forms. From land, sea, space, yeah?
Correct.
Okay, great. We've got Leila Hodgic, they're Global Head of Risk at BBVA Spark, which is the dedicated banking division for high-growth startups and VC funds, offering everything from day-to-day banking to venture debt. And then over the far end, we've got Antonio Migliore, founder and CEO of Moova, which is a Buenos Aires-based last-mile logistics platform using AI to connect businesses with idle delivery capacity across Latin America. So, bienvenidos a todos, and thank you very much for staying with us all this time. So, you know, this is one of the things that I do with my life, which is interviewing founders and investors and being on stage with great people as well. One thing I find they always agree on, and they don't always agree on everything, is that startup founders need to be great storytellers.
Yes.
So, since we are in the business of keeping our audience engaged, this chair is very wobbly, why don't you each, to start with, tell us the best and worst story, I mean as briefly as you can, I suppose, that you have either ever told from your personal experience or heard someone tell, maybe in a pitch meeting, that you've shared in the past, or perhaps this will be the first time that you share it with an audience. So why don't we start with you, Chris?
On any topic.
Well, I mean, hopefully related to the technology topic that is at hand.
Because that's an important clarification. I think the best story, let's see. We had the pleasure of being a very early investor in one of the leading humanoid robotic businesses in the world today. And when we first started diving into this was probably two and a half years ago, and we spoke with a number of different founders, a number of different companies. And we were looking for someone who was this incredibly candor-rich, integrity-rich founder who had the IP, the partnerships, and the ability to build something very special in a space that has a lot of sizzle behind it right now. And we had a chance to identify this company from a plug-and-play opportunity that's based in Austin, Texas. So the team went down, we met with them, we were looking at a number of different opportunities, and in the course of this discussion, we were told, you know, we really like this discussion, Chris. We're excited for you guys to come into our next investment round about a year from now, which was disappointing. We were really excited about this business. And it so happened the following week I was at breakfast in Detroit with three good friends of mine, one of which is now one of the leaders at Boston Robotics in terms of some of the things they're doing with Atlas. And he said, Chris, you know, what are you thinking about humanoids? And we just started kind of like going back and forth with each other, kind of being a little cagey. And finally we came to the same discussion. He's like, well, are you going to invest now? And I'm like, what do you mean now? He goes, well, there's a small round that's still open from this small breakfast diner in Detroit. So we immediately called the company, had a chance to engage with them, made clear that we've been investing and interested in this for some time. And from a conversation over bacon and eggs in Detroit, we were able to move ahead of investing in the next round. We invested in that business, Apptronic, at a $250 million valuation. Most recently, they closed their most recent round, which include Google, Mercedes, and others, at a $5 billion plus. Had we missed that, we would have invested at a $1.3 billion round, costing huge returns. So I think that's a story of just staying engaged on a topic in places you might not expect there to be value.
Right.
Value can be found.
And also the importance of not skipping breakfast.
Never skip breakfast. Okay. Most important meal of the day. That for sure. And
I'm glad it's not one of those humanoids we love watching online that kind of, you know, try and dance to Billie Jean and go upstairs and then
no, this is much more.
Okay, much better. Okay, Leila.
Good story for me, I think I start to see it more recently in a lot of meetings, actually the P word being sort of bandied around, which is profitability, right? I think for a long time the stories in any meetings were all about growth, the next capital round, and that's what we saw. But I think increasingly, I head up risk globally, so hearing the P word, hearing capital efficiency, hearing, working through a downturn and a cycle is really a good story for me. So, and I think this will be, what really helps us also grow the European ecosystem.
Okay, and perhaps I don't know if you've got this was like such a bad story or something, not from, your personal perspective. It would be nice to get some balance here. We've had a couple of nice positive things.
No, I will tell a good one,
Hey.
if you don't mind.
Fair
I have
enough.
really good one, sorry. We represented Argentina in front of the G20 as the company representing Argentina for Digital Innovation Network. We did this twice in a row. First, we didn't win. Second, we did. When we did, I was actually in a hotel in Dubai, alone by myself, because I was there because I have some other meetings, and this competition was in Indonesia. I can't fly back and forth, so I sleep 2 hours, and I participate, I compete. It was like 7 minutes competition. You compete against Germany, US, big countries. Actually, we won. But when I finished competing, it has like 3-4 hours for things happening, and I went to sleep. I had 2 hours sleep. And then they called me from somewhere in Indonesia, Bali. They said, you have to be, I was like completely not presentable then I get my black t-shirt, which was like kind of sleeping. I put my coat on just to spend there waiting for the winner to win, and they say, and the winner is Muba from Argentina. I have the video, like music or so on. I had to say, well, thanks. They were expecting me to be there. The thing is, when they have the final picture, I was doing the whole pitching with my suit perfectly, and the winner one was like different. It was a super great story, and afterwards, we get a big investor, which is Toyota, entering because of this, the validation that this kind of competition won. So many things happen in very short time like that.
And just to be clear, this was like you accepted it over Zoom or something, the award?
There was everything was by Zoom.
Yeah.
When I had to receive the prize, it was by Zoom.
Yeah.
With this T-shirt, black, and some coat.
And
completely
pajamas
different. No, it
beneath?
was not. I don't remember. Yes, pajamas was there.
Just as long as you don't do it on stage,
Super online.
I think
Super online.
we're okay. All right. So moving on from that start. So again, this panel is really about the things that we don't naturally see or understand that startups and the whole ecosystem has to go through between making that leap from startup to scale up. The next question is this. So what is a decision that you knew was right either for your business or for one of your portfolio companies, but hated making, or that they hated making? So Leila, why don't we start with you for that one?
I think I make these all the time, right? So I chair the investment committee, and I see business proposals all the time. I think sometimes you need to make hard decisions. Yes is not always the right answer. It's about the right path forward, and sometimes you need to take a step back in order to have a long-term resilient path forward, right? And kind of going back to the topic around growth at all costs, and sometimes it's a case of growth versus sustainable growth, and for us as a debt investors, this is something that we continuously have to look at, and ensuring that sometimes saying no actually means we're able to grow with the company long term.
Can you give us a specific example? Like, you don't want to mention the company's name, maybe kind of the area that they had to do, I don't know, XYZ, and they weren't happy, but ultimately it turned out.
I think it can be situations where companies might need debt continuously, a follow-on round of debt or whatever it might be, and the risk profile of what they're looking for might actually be more akin to an equity-type investment, right? So I think companies really need to look at their capital stack and ask what is debt to be used for and what is equity to be used for, and debt rounds might not be the right thing for the type of thing they're looking for. So if it is, product market fit for a new product or a new geography, then it would be, it is not the right thing to fund that through debt. And we can partner with the business and we can complement an equity round, or we can provide a little bit of additional runway. But we, from a debt perspective, shouldn't be funding innovation. Really, that is something to be done through equity. Okay. So saying no to follow-on rounds.
Saying no. There you go, Antonio. So a decision you kind of had to make, but hated making.
I should say to fire talent, because sometimes you cannot retain talent when you need to take decisions which market you will be dedicating more efforts to, because you always have limited resources. In any company has the same problem. So sometimes great people enter a company and you have to say yes. You don't have any real explanation. You want to retain them. I try to teach my team that you cannot hire a person if you cannot fire them. So you can be able to fire, because otherwise, but I have to do this a couple of times. People that I knew that they will never get back again to them, but I have to say I cannot keep paying you instead of paying this kind of profile in whatever place. That's a hard one.
Right.
Yeah, I would say I love this question. As founders, anyone that's a founder or an investor in which you've raised your own fund in the crowd, you are going to be told that your vision, your underlying philosophy, and your strategy is wrong again and again and again, and you must believe in yourself. For me, about 10, 11 years ago, I started to speak to a belief that I had deeply in my bones, that the East and the West were going to bifurcate, beginning with the US and China, but then holistically, and we would have a bifurcated world when it came to technology development and capital deployment, in which there would be a point at which some people have to choose. And this was a conversation 11 years ago that I'd have full-throated arguments with people. This is never going to happen. Look at the supply chain in Shenzhen. We're going to continue this. Even when we started Assembly 6 years ago, same thing. And here we are. And this is very much kind of a gospel understanding. Everyone's singing from this hymnal. But we got there through a geopolitical and an underlying technology development ecosystem that 11 years ago people were right to argue with me, frankly. But for you in the crowd that are trying to build something that you believe is right, and that's not to say don't listen to input. You want to continually gut check your assumptions. You want to come back to what is ground truth, but you have to believe in that vision.
Okay. Again, startups, when you're speaking with startups, when you're investing in startups, we often hear the kind of refrain that what got us here won't get us there. Looking back, what's a decision or a belief that initially helped your company or a company you're investing in or providing debt to grow, but later became an obstacle? And at what point did you realize that was a problem? So, Chris.
That later became a problem.
Sure. Like company you're investing in, doing something, and then that way of doing it
was a problem.
Became an issue and had to be changed or kind of,
Plenty of those. And so I think I've had the pleasure over the course of my career, or the unfortunate happenstance of investing in a lot of parking tech companies. I've done 5 over the course of my career, 2 in data, on-street and off-street, 2 in payment, on-street and off-street. In one now, kind of the recognition economy with AI, a company called Metropolis that's done incredibly well in the United States. But there was one business that we invested in early in my career that was focused on automated gate arms. And we had a strong belief that we could immediately bring these into parking facilities and have instantaneous revenue and uptake. That was not true at all. The incumbent industry wanted no part of this low-cost, high-availability kind of gate. We were blocked at almost every turn coming into the operators, and that company unfortunately met an unfortunate demise. Oh. But I think it was the strategy behind that, and then continuing to push into it, but just not understanding the product and the sector you were going into deeply enough. That was something where I wish we had done one more turn.
Oh, it's a shame, because I've got a friend in private equity who's invested in a parking gate company, but we'll try and do the deals afterwards.
Absolutely.
And Leila, from your perspective.
I would say we see it often. The founder who has taken a company from zero to product market fit might not be the same founder that's going to take it from that to scale, right? And I think either those founders need to continuously reinvent themselves, or they need to surround themselves with a board, with a CFO, with investors that will challenge them and drive them to make the right decisions. Because growth doesn't necessarily equal simplicity, it equals complexity, and having the right partners around you that will not necessarily always nod their heads, but that might challenge you and help you drive the right behavior is really key. And we really see a correlation between founders that aren't able to sort of do that and success.
Right. And of course, Antonio, a prime example of a founder who does adapt and still remains the right man for the job. But I mean, you must have had moments when you thought that maybe you weren't.
Yes, for instance, the thing is you have to follow the market. Like some years ago, you have to go growth at any cost, then you have to go profitable at any cost, are completely opposite, 100%, 180 degrees. And so when you are pursuing growth, we acquire this company in some country, in Colombia. It makes sense for many reasons. We grow in top line, we grow in profit, but we separate from our core business. Then when we had to go to be profitable, we have to get rid of that because of the same reason that we have to acquire. So when you have to follow the market, and this is when you are not profitable, you have to take decisions that make you move like certain zigzag until you get your path. That was a harder one, to build a whole acquisition and then to deploy and to try to sell it down anyway, whatever.
Okay. All right, and Leila, just a couple of questions ago, you were talking about resilience, and I've got so many things that I want to ask all of you, but we don't have a huge amount of time. But I mean, I think we've all been told since we were children that the hare doesn't always beat the tortoise. Likewise, companies that succeed aren't always the ones that are growing fastest, but the ones that build resilience as they grow. So what separates sustainable scaling from, I suppose, more fragile scaling in the grand scheme of things?
Yeah, I guess what we look for is, obviously we look to invest in, amazing founders, amazing ideas, amazing companies, but what we also look for is companies that not only can raise equity now or attract growth right now, the companies that can do that in a downward cycle, right? Again, I go back to the fact that we are debt investors. So, if things aren't so rosy, are they surrounded with the right people? Is it the right founder that has optionality, that has the skill set to take that company through a stress scenario or a difficult situation? And this is really what we look for that to be resilient. And it's a series of not just big transformative decisions. It is a lot of constant, small, iterative decisions that need to be made.
Chris? I mean, the honest answer in my experience is you don't know. And what I mean by that, not to punt, is that a company I mentioned, Metropolis, in our portfolio as an example, this was a business that began as the ability to have your vehicle become the token for any type of payment, but starting with parking. So a vehicle comes in and out, there's no gate. The future parking is gateless, by the way. I'm sorry for your friend. But it really was the Trojan horse for looking at all types of automotive payment, whether it's car wash, fast food, fuel, charge, infrastructure. And that was a business that began, let's focus on looking at this on a garage-by-garage basis. The growth was too slow. We weren't seeing the type of upticks in the KPIs we'd need to raise more capital. So we raised, with our round, we raised and acquired the 11th largest parking operator. They had 600 locations around North America. We'd already deployed about half of them. We had a strong belief if we could acquire them and then just immediately deploy our technology, we'd see material revenue uptick. On average, 9 months later, we found that we doubled the revenue in those places. So then as a board, we looked at the document, we looked at the KPIs, and we said, well, what else can we do? That means we can acquire any parking operator in the world for more than anyone else can pay and create more revenue. And what we did was we did something, the first GBO, a growth buyout, where we acquired the largest parking operator in the world in North America for $1.7 billion. And the smaller technology company acquired the old line brick and mortar business. And we could do that because we had the technology that could enable their assets in ways they could not. That was a discussion, if you had told me when we invested 2-3 years prior, we wouldn't even have dreamed of. So scaling is, yes, it's staying true to these things and thinking about capital, absolutely, but it's also being very present and looking at the data with the resources and the board and the advisors you put together. And we've zigged for this long, and now maybe it's time to zag, and being very honest about the data in the moment in time.
Antonio?
I
How
would
do you
say
ensure that you scale sustainably rather than...
yes. I was trying to select to pick and to answer what you're asking, not what I like to answer. And the first one, yes. On my side, sustainable growth sometimes depending on the geographies, because there are geographies, for instance, in Latin America that are so unstable. So to pick the right geography, maybe sometimes is harder to explain your current investors. When you present your business plan, you say, but you were never trying to tackle the US. There's too much competition and whatever, and you have to pick your own decision and to go for that. And that's what we did. Try to build a business that converts in repeatable business, you know. That's how I look at it. You have to find where you have to invest, which are the best geographies to invest in.
But at the same time, I mean, over the years, again, whenever I speak to founders, some will tell you, oh, it's really important to be capital efficient, because of them, when the investment spigots get turned off, you can still kind of, thrive. And there are others that will say, well, no, you need to raise as much as you possibly can when the going is good, and that way you've got all the money you need for when things get worse. Right now where we are, and we've just seen it this week with the announcement of Anthropic's IPO, obviously got SpaceX, and there's so much, I mean, Google just placing, hey, $80 billion, thank you very much. So much money seems to be available right now, so capital doesn't seem to be a problem at the moment. I guess further down the food chain, perhaps it's a little trickier. But the question is, what is the best strategy here? Is it for the startups to kind of raise as much money as they possibly can so that they are resilient when things turn down? Or is it to be capital efficient from the start in order to make sure that they can, get, to use the P word, as quickly as possible, so that they don't need to worry when markets do turn south? Leila, why don't you start with that?
I would say, yeah, for sure. There is a lot of capital out there, but especially further down the spectrum, getting the right price ground might be difficult, right? So you don't want to give away too much of your equity too early on either. So having the right and striking the right balance at the right time is key. Knowing what your options are and knowing to complement your equity raise with debt and knowing what your options are there is really the key, and knowing what to fund from what base. And keeping enough room open so that you can raise in the future as well is really key. So I would say yes, raise, but don't overextend.
Don't over-raise. Okay. Antonio?
My case is exactly, I agree with Leila, sorry. But having said that, so you have to have the balance, not to raise too much money. I tried to did that in the past, but having said that, I think that we have built a lot, but we could have been building much more with more capital. So if it had to be like binary, I prefer to have the capital and more dilution rather than not having that at all. Even when you don't go bankrupt, you scale more slowly when you don't have the money.
But if you raise more, then there's going to be more expectations and more pressure from investors, right? So you have to deal with that.
Pressure is not a problem in this job. You take by granted that it's pressure the whole day. It's like that. Maybe you have to take care of your governance, because you start losing governance, that's a problem.
Chris,
I like that answer a lot. I would say that it's really important with this question. You have to step back and you have to prioritize. And what I mean by that for entrepreneurs, if you can avoid raising capital from guys like me, you should. You guys are doing all the work. You guys are creating all the value. Why would you give that value to a VC? Well, the reason you give it to them is because that capital will provide more value. And if it doesn't, you need to do that equation. But also, it's not just about the capital, it's about the access. If you have a generalist VC who says that they can do all things under the sun for you, they're lying to you. You need to find subject matter experts who can bring networks to bear, and there's a reason why you're taking that capital, if you have that choice. Sometimes it's just clean capital, and there's nothing wrong with that as well. But take as little as you can, and then I would say whether it's a great funding environment or a bad funding environment, my CEOs and the boards that I sit on, we have a strong rule of thumb. Let's have 18 months of capital when we raise right now. It gives you optionality. What you don't want is to be at the end of your capital on account and going out to raise, because you're automatically disadvantaged from a negotiation perspective. But you raise capital based on what you need to fund your business to create as much value for yourself and your stakeholders, and be really careful about what stakeholders you bring into your tent. Make sure there's trust, and as much trust as you can get when you begin, but people that bring more than money.
Okay, I was going to try and squeeze one more question in, but I see the image of Paris appearing over there to the side. So I'm afraid we are out of time. So do please join me in thanking our speakers for really engaging and fascinating conversation. Thank you, Chris. Thank you, Leila. Thank you, Antonio.
Thank you.